Well, thank you everyone for coming out tonight. If you guys don't know, my name is Lance. I'm the FINSA president. I really appreciate each and every single one of you coming out today. With that being said, everyone Zoom, if you guys can hear me clearly, that'd be amazing. That's good. Okay. With that being said, if you guys don't know yet, we are FINSA. We are the Finance Student Association here in SFU. And what we do here, our mission is to inspire and to nurture the next generation of finance students here in SFU as well as around BC. We're doing this with one student, one concentration, one school at a time. So it's amazing to have everyone here because we're trying to bring financial literacy to everyone here in SFU. With that being said, I'd like to start off by acknowledging the land that we're on today. We're gathered around the territories of the Coast Squamish people, including the territories of the Squamish and as well as the Skokomish nations. So I just want to say thank you for each and every single one of the very nations that we're standing on their lands today. With that being said, I'll run down the timeline of what we're going to be doing here tonight. So at the very beginning, we're going to do a little bit of introductions, just knowing what SFU FINSA is, as well as what we're doing here tonight. And then we'll move on to our very first speaker, Christopher, and he'll be talking about finances and how investing 101 is all about. Then we'll be moving on to our second speaker from RBC. And then we'll move on to Annika, who's from Blossom Social as well. With that being said, we'll have various breaks throughout the night so that everyone can take a little stretch, use the washroom as well. And yeah, with that being said, I'll move it on to our sponsors here today. So our very first sponsor is BC School of Business, Red Bull, Blossom Social, CFA, RBC, as well as Brander. These various sponsors that we have today helped us make this possible. So really appreciate each and every single one of them. To move forward, we do have a raffle prize partnered with Blossom here today. And if you guys don't know what Blossom is all about, we are an app that allows for you to, it's kind of like Wall Street Bets, but it's more verified in the sense that you can link your brokerage account. So what we'll be doing is that we have a partnership with them. If you sign up with code FINSA, you'll be receiving a $5 from them, as well as we do have prizes at the end. So if you guys could sign up, use a QR code that we'll be giving you later on tonight. That'd be amazing. It helps us both FINSA as Blossom Social as well. So yeah. I'd like to welcome our very first speaker from CFA. It's Christopher Yee. Mr. Yee is a chartered financial analyst, as well as a professional educator. He used to work at Nicola Wealth, but now he is an educator that teaches all about wealth. With that being said, he is a BD graduate, and I would like to give him a warm welcome. So,
hey everybody, thanks for coming out. Thanks for FINSA for setting this up and for Siraka for reaching out to me to speak to you guys. So as previously mentioned, I'm a CFA. I also went to school here in a long time ago, maybe like 2017. The purpose of my presentation is to give you a little bit of an introduction to investing and maybe address some of the questions that you guys might have and maybe sort of some of the concerns you might have. So maybe, my concern, hey, maybe would be, well, do I have enough money when I'm 45 to retire, have like cocktails on a beach in Bali? Or maybe for you guys, maybe I can't afford to buy groceries next year. Or maybe you guys are just thinking about what kind of jobs you guys might have when you guys graduate. So hopefully with my presentation, I might be able to clarify that a little bit for you or answer some questions around that. So when you start with investing, you got to think about what are your goals, right? So liquidity is one of the biggest concerns, and that is what do you spend right now and what are you looking to buy in the future? So for you guys, maybe it might be buying a house. Well, how am I going to come up with $600,000 for a single bedroom within the next 5 years, right? So you have to think about that, right? So if I'm gonna withdraw 600,000 in 5 years, how much money do I have to save each year, and how much money do I have to be making each year? So what comes with that naturally is risk tolerance and your return objectives. So naturally, people are risk averse; they're scared of losing money. That's why we buy insurance, right? But you have to consider, hey, like how much am I willing to tolerate a fluctuation in my portfolio value, and what am I looking to get out of the money that I invest. So the first step is to open a brokerage account. Now, there are two types. There's a traditional brokerage and a discount or free brokerage. Traditional brokerage would be one that's linked to your bank. So let's say you bank with RBC. So RBC will have a brokerage attached to that banking to the banking side of your account. The other is discount or free brokerage. I highly recommend this for you guys because it's a lot cheaper. Usually when you trade at a traditional brokerage, or you buy stocks or sell stocks, it's going to be $10 a trade. If you use a discount free brokerage, they won't charge you anything. So an example of a discount or free brokerage would be like Wealthsimple, if you guys have heard of it, or National Bank. So I want to illustrate why returns matter and why saving matters. So there are three scenarios here that I've outlined. In the first scenario, you're getting 7% per year. In the second, you're getting 6.7. And the third, you're getting 5%. So the point I'm trying to illustrate is that the returns that you get deeply influence what you get at the end. So if you start saving in year one with 10,000 and you have a 7% net return, at year 30, you have 76,000. Compared to 5%, you're at 43,000 at 30 years. So you paid 30,000 in fees over 30 years. Now, I'm going to illustrate it again, and I'm sure some of you might have been familiar with this. It's a basic calculation in your financial calculator. But basically what it means is that for the first scenario at the top, so compounding interest scenario with a low cost index ETF at 6.7%, and you're depositing $1,200 per year, after 30 years, you'll have 190,000. Now, if you're compounding at the same rate or compounding at a different return at 5%, but you're depositing the same amount, assuming no taxes, you're actually down 60,000. So you paid 60,000 in fees over 30 years. You know, 60,000 could buy you a nice car, right? So it's something you have to consider when you're investing. So when you go to your bank, let's say you meet your financial advisor, they'll probably pitch you a couple of mutual funds to fit your risk and return goals, right? But one of the things that people don't always look at is fees. So you should always pay close attention to fees. So when you open an account, there are three types of main basic accounts. The first is a tax-free savings account. Now, this is a savings account for Canadians who have a SIN, a valid SIN, who are 18 years or older. The total cumulative room is 81,500. Now, they introduced the TFSA in 2008, and I don't think any of you were 18 in 2008. So you guys don't have 81,500. So you're gonna have to Google to find out how much you have, but I think it's around 50,000. So you can contribute 50,000 into this account, and anytime you make any money within the account, there's no tax. The cool thing about this account is also you can withdraw that amount. So if you say put in 60,000 this year and you took out 60,000 to buy something, you can recontribute 60,000 in the following year. But you should be very cognizant of the fact that there's a penalty. So I've had come right into this a couple of times where people overcontributed and they have to pay 1% in excess fees per month. RSPs. So if you guys have started working, you guys will already have accumulated RSP room. An RSP is called a tax deferral account. Basically, what happens is you accumulate contribution room as you work, which is a percent of your total gross income. Every time you contribute, it lowers your current income. So let's say I make 60,000 this year and I contribute 10,000. Well, that means I save 10,000 multiplied by the tax rate, my marginal tax rate at 50,000 in tax savings. So these savings grow tax-free until you're 71. Once you turn 71, it converts into a RIF. And a RIF is basically an income fund. And what it means is that every year after 71, you have to pay out a certain percent out of that account. So it would be like maybe 4% when you're 71. So this doesn't make a lot of sense, right? Like, okay, so I save taxes early on. So the point is that let's say I'm hoping that all of you guys make a lot of money. So let's say you make over $100,000, right? So the tax savings on making an RSP contribution at 100,000 is very high. But when you're old, when you're say 71, you're getting CPP, OAS, that's probably like 30 grand, right? So when you take your RIF income, you're getting taxed at the 30,000 or 40,000 marginal tax rate rather than your 100,000 tax rate early in your career. So you're saving money. And the last thing to note about this account is the home buyers program. So this allows you to withdraw $35,000 out of this account tax-free to purchase a house. Now you might be thinking, oh, well, what is $35,000 going to buy me? Probably nothing, but it's something to consider. The last one is a non-registered or cash account. So this is a fully taxable account, and there are a lot of intricacies with taxes. I'm not an expert in tax, but there are a couple of taxes here. So there's capital gains tax. So let's say I bought TD shares for $10,000 and then I sold them for $15,000. Well, 5,000 of that multiplied by 50% will be taxed at capital gains. There's also capital losses. So if, say you lose money on an investment, that means that you can claim that loss against a future gain, meaning that it just nets it out. And then there's a dividend tax as well. And the last one is an interest or investment income tax at your marginal rate. So what should you do? What do you think you guys should do? Well, if I had 100,000, what would I do with it? Well, how much money are you guys making right now, right? So if you're making money, right, and have you maxed out your TFSA? So the first thing I would suggest anybody to do is to max out your TFSA because there are no restrictions on that account. Everything you make in that account is tax-free, right? But there's a caveat to that. There's risk and room destruction. So let's say I have 80,000 in TFSA money and I put $80,000 into a really bad investment and it turns to like $500. Well, I'm not getting that $80,000 back and I can't recontribute $80,000 into that account. So you permanently destroyed that tax-free savings shelter, right? There are other considerations such as asset location decisions and tax efficiency. So when you have a TFSA and RSP, there are no taxes in that account, right? So when you buy an interest-bearing, say like a GIC, for instance, the taxes on that, there's no taxes on that. But if you were to have it in a cash account, it would be taxed at your income level, right? So when you have these registered accounts, you'll have an opportunity to designate a beneficiary. For beneficiaries, I highly recommend you do this because if you don't, then it'll go to your estate when you pass away. If it goes to your estate, then you'll be hit with probate tax. So let's say, for example, for me, if I were to pass away, my TFSA and RSP funds would go directly to my brother because I designated him as a beneficiary. But if I hadn't, then it would go through estate tax, and then the government would decide the value of my non-registered and all my estate and tax it. Life insurance. Well, life insurance is a tough question and it's tough to know whether or not you need it. But since you guys are young, your premiums will be really low. So you won't be paying a lot of money. Say when you're 60 and you try to buy life insurance, your premiums will be incredibly high because guess what? You're probably going to die in 20 years, right? But if you guys are 20, you guys have 60, 70 years to live, right? So your life insurance will be a lot cheaper. But I'm sure you guys are not too concerned about life insurance, but when you guys have a family per se, or you have someone that you want to leave money to, life insurance is a good tool because it's entirely tax-free. So when you pass away, it goes directly to whoever you designate as your beneficiary. The last one is wills and POAs. I don't have a will, but POAs are very important because let's say you're incapacitated. Let's say you're in the hospital and you can't do anything. You can't make financial decisions. When you designate a POA, someone else can make those decisions for you. So they can go to the bank, they can withdraw money for you, they can buy the things that you need. So investment philosophy. So what should you buy? What's a good investment? Traditionally, investment philosophy revolves around two types of assets, stocks and bonds. Stocks is ownership in a company, and bonds are basically a loan to a company. So if I was to start a company today, I'm going to start a plumbing company, right? I have no income, but I want to make a lot of money in the future, but I want to build a factory first. So I'd go out to you guys and ask you to buy shares from me. And then you guys would have common shares of Christopher's Plumbing Company. Now, on the flip side, I want to sell, instead I want to borrow money from you guys. Let's say I buy $100 from you, right? Then I owe you 6% each year, right? So there's a contrast between the two asset classes. One is an ownership in a company and the other one is ownership in someone's debt. So what is 60-40, conservative, balanced, and growth? Those are just the typical archetypes that you guys would be put into. So when you go to, say, a mutual fund advisor, they'll say, oh, well, I want to get 8% return, but I can tolerate high risk. Then they would probably give you a growth profile and they'll give you 100% equity or 80% equity or 70% equity. And it's all just a mix of that. There are other like asset classes like alternatives or private assets. So that would be like, say you want to invest in like a hydro project in Peru. Like there are opportunities to do that. And these type of like assets are not correlated to traditional market assets such as stocks or bonds. Of course, with finance, it's one of those things where it's a very big universe and there's a million of things that you can invest in, right? So you have to further explore those things and find out what you like. And then lastly, there's asset choice, which is between mutual funds, ETFs, and individual stocks. So mutual funds are your basic like packaged solution where there's a portfolio manager, you're probably out in Toronto, who chooses a bunch of stocks for you, packages it together nicely, and then you just keep buying it for the rest of your life. The ETF is very similar, but there's a lot less active management. An ETF usually tries to simulate, or sorry, not simulate, but replicate a index. So you guys may have heard like S&P 500 or TSX, Dow Jones. These are like the largest public companies in Canada and USA, right? So the ETF basically copies that. So let's say, so for instance, the NASDAQ, I think 50% of it's Apple. So an ETF that replicates NASDAQ would have 15% of your funds invested in Apple. And the last choice is individual stocks. There are a lot of like different semantics involving in stocks. You know, a lot of stuff that I could talk about for hours and hours on end, but I'll leave that for later or when you guys want to talk to me later. So I'll give you an example of a portfolio. This is called the IB portfolio. And this is actually was first introduced at Harvard. Basically, they were trying to find a way to invest the foundation funds at Harvard. Well, obviously to serve like maybe make purchases at Harvard. So like new buildings or like students or things for students. And this is how they allocated their portfolio. So of $100,000, 20,000 would be allocated to US stocks, international stocks, commodities, intermediate bonds, and real estate investment trusts or REITs. And this is what it would look like over a long period of time, right? So after 20 years, right, you can see that the IB portfolio actually has less than the S&P 500. It's actually a lot lower at an 8% compounded annual growth rate versus 11%, but the risk is actually lower. So you can see that the standard deviation of this portfolio is 12% versus 14%. And you can find more resources on these model portfolios at CanadianCouchPotato.com. It's sort of like a website for people who really are lazy and don't want to pick stocks or ETFs. You could just go there and you could just replicate something. It's very easy. Any questions? Go for it.
That's money that's come in and give us the market cap, or is it just initial deposit rate? 1,000 or 20%?
Good question. No, so it's just the initial deposit. So you actually have seen like people who make super risky bets in their TFSAs. So I think there was like an advisor in Toronto, like maybe 5 years ago, who bought a ton of Tesla in his account, and it was like 100,000 in the TFSA, and he made like $1 million off of it. So he made $1 million, and it was all tax-free. And the CRA was like, no, you can't get away with this. So they went after him. Yes.
So I just want to verify for the again, TFSA, so it's 81 your total lifespan, 81,000 your total lifespan that you're allowed, put into that account, or is that?
That's if you're like, if you were 18 when they introduced the program. So they keep adding contribution room each year. So last year was 6,000, and I believe next year will probably be 6,500. So each year they actually keep adding more contribution space. So each year you should be able to add money. I think when I was younger, it was struggling to fill that cap. So like there's like 6,000, like there's a lot of catch up you have to do. Cause like I was thinking for you guys, maybe if you're 20 or 21, 22, you probably have like 20,000, 24,000 in space. And so you should maximize that 24,000 first, but it takes some time to save that kind of money.
Good question here. Isn't that just like adjusting for inflation there? They increase year by year?
Yes, so it's inflation adjusted. Yeah, we're good.
Any more questions for Christopher?
Oh, I'd like to advertise something actually. So I used to go to school here. I did the BD program, I did all that. And in my first finance class, I think, no, not 312, but 315. I took it here with a professor named Emrul Hassan. I don't know if he teaches here regularly, but he teaches summer now. But one of the things that he did was when I first got into that class was he promoted the CFA program. So if you guys are serious about a career in finance, I strongly suggest that you explore that program, get a little more information about it, and see if you want to do it. For me, it was a great experience. I did it. It took me like 3 or 4 years of like nonstop studying, but it was well worth it. I actually teach it now at the school with finance training. I also teach it, will be teaching it for a different firm shortly. So you guys have questions about that, or you have questions more about investing that you want to ask me in private, or anything about career, I'm passionate about those things. Feel free to reach out.
With that being said, Christopher, thank you again. I personally learned a lot about TFSAs, RSPs, asset allocation. So learning all those things help you with the basics of finance and being able to invest in the market. So really appreciate that. With that being said, we'll give everyone 10 minutes to take a little break. You can take a little stretch, washing break, and then we'll resume back at 6:50. Thank you. Welcome back, everyone, from the little break that we had there. We'll be moving on to our next speaker of tonight. So I would like to welcome up to the very front of the stage, Ashkan from RBC. Let's give him a warm welcome. Thank you. Oh, before I give it off to him, I'll just give a little introduction of Ashkan. Ashkan has been a portfolio manager with RBC for 18 years now. So he's been there for a while. So he has a wealth of knowledge about the wealth management space. With that being said, yeah, I'll pass it off to you and we can move to slide deck.
Great, thanks. I feel like I should also promote the CFA program. It's worth every penny spent, and it's worth every hour that you study. I highly recommend it. I went through it right out of, I think I wrote level 1 as I was in my 4th year, and then just completed it right after. It's definitely worthwhile. With that, yeah, my name is Ashkan Golkar. I'm a portfolio manager with RBC Dominion Securities. Firstly, I want to thank the Finance Student Association for hosting us, and thank you all for coming. I'm going to cover 5 general topics today on investing and financial markets, different types of asset classes, risk management, inflation, portfolio management, and ETFs and index funds. There may be some overlaps with the previous speaker, but I'll try to skip through them. I'll give a quick background about my firm and my role there. So Dominion Securities is a subsidiary of Royal Bank of Canada. It's Canada's kind of leading wealth management firm with over $500 billion in funds under management. My immediate group, we look after $1.2 billion of high net worth individuals, corporations, foundations, and institutions. I started about, I think it's my 19th year. I got an internship at RBC while I was going to Sauder School in my 2nd year. And then the rest is history. I haven't left. They kind of locked me up. I think you're all familiar with these types of asset class. I'm not going to spend too much time on it. It's pretty much comes down to cash and cash equivalent, bonds, and stocks. What I want to focus on is maybe that, the alternative investment side. That category basically includes private equity, real estate, infrastructure fund, real estate funds, and it used to be a little bit more, I would say just on the institutional side, that's where the investments used to be. Now it's a little bit more popular on the retail side with liquidity available, and it's just more available to retail investors. Here's the history of performance of these asset classes. As you can see, when you go along the risk curve here, returns are higher, but so is the standard deviation and the volatility. What I want to hammer home here is putting a diversified portfolio here right at the end, and that blue chart pie or blue bar there. It shows these are 5-year rolling returns, any 5 year over the last 5 years or over the last 25 years. You can see if you've got a diversified portfolio, you've barely had a 5-year period that that portfolio has been down. And in fact, there's been periods that it was up 12.4, but on average, it's somewhere around 7 or 8%. I think one thing you always hear about stocks and investing is that permanent loss of capital. You hear so and so they lost all their money, in a stock. Such thing does not exist if you invest properly and if you have a diversified portfolio. It can happen if you put all your money into some penny stock or the next hot idea or something like that. Sure, I think you have a better chance of going to a blackjack table or something. Stock market is not a forum for that kind of thing. So if you're investing, do it properly and do have some play money, but just limit those those bets, I guess. Why buy bonds? I guess it gives you diversification, first of all, from other asset classes. It gives you safety, except for this year. The bonds have done almost as bad as stocks. And they have some sort of an income predictability. They all pay an interest twice a year. It's usually a more conservative investment. Stocks, on the other hand, they also offset your risk on the bond portfolio. They give you higher returns, and I think we're all sort of get excited about stocks and the movements. I've been investing since I was in my teens, and that's what got me into this industry. I just like the research, and I think we all like making money. Stock returns there's two components to it. It's a total return. There's capital gains, meaning price appreciation on a stock. You buy it at $10, it goes up to $20. There's also the dividend income, which is key. My focus and my practice when I'm selecting companies, I spend a lot of time on the dividend, and that's where I do the analysis on the dividend growth and the payout ratios, not just the highest paying company. I'll actually stay away from if you find a company that's paying you 8% in dividend, run away. There's something's wrong there. Ask yourself a question: why are they paying you out 8%? That means they can't reinvest in their own company. They're not confident in their own business. So you want a combination of capital gains plus dividend, but dividend growth. It's also a great inflation hedge. Stocks are up to a point. I was reading a study that I think the fine line is 5%. Once inflation crosses 5%, then your return diminishes. But prior to that inflation, as most of the companies, strong companies, can pass on the cost to the consumer. The type of companies that we invest, this is the life cycle of every company. That introductory phase is what you can call, I guess, the startups. And then you get into the growth and mature companies, and then on the decline side. My focus is on the growth and kind of matured companies. Those growth companies are growing. They've got very high sales, growing sales. The example would be a lot of the tech stocks up until this year. And you can make a lot of capital gains. They don't pay a dividend. They're reinvesting heavily into their own business. And then on the maturing side, you got companies that are paying, Royal Bank is a good example of a mature company. It doesn't grow that fast, but it gives you a solid dividend, good free cash flow. It doesn't pay every penny that it earns. It reinvests some of it into the equity. Be wary of the companies that are declining. In our portfolio, we have, I think, roughly 35 stocks right now. And I kind of manage it below 40 at all times. But the universe that I look at, there's 10,000 companies out there. I spend more time trying to identify what companies not to invest in, and that's really important. You want to, you hear ideas all the time. This company is, they got sales going through the roof, etc. Be careful, because there's a lot of companies that are just ideas. They're not actually making money. So I try to stay away from trouble and just focus on companies with good earnings, good cash flow. And on the decline side, again, once a company reaches that level, they're sort of dead. I mean, Intel is a good example in the semiconductor. All the chips in here are probably Intel. But our phones are changing over to other semiconductor companies and other chip makers. Well, Intel used to be the #1 semiconductor company a decade ago. They're so far behind the competition now, whether it's NVIDIA or AMD or Applied Materials. And while their stock prices doubled and tripled and quadrupled, Intel continued to go down. They were in the right sector, but they were just declining and they were losing market share. So you want to stay away from companies that are losing market share. This is the sort of the different stages of economic cycle. We're probably, I think you hear all the talk about going into a recession. We may not. I don't know. I'm not an economist, but either way, the growth is going to slow down. It is slowing down. Whether we are in a recession or not, next year is going to feel like a recession for a lot of people, and that's the best time to invest for all you guys. You want lower prices. I mean, even think about real estate. I think you all want real estate to go down because you want an opportunity to buy at some point. So lower markets, all that means is higher future rate of return. Just because stocks go down, that's not a bad thing. It increases your forward returns. So if we're in this, let's say we've peaked last year and we're going into a recession, let's say. The nature of investments have to be different. Those growth companies that worked, in the expansion era, they're just not going to work, especially when we have high interest rates. So you want to be a little bit more defensive. Utility-like companies, healthcare. That may even be too late. I personally think we're that's kind of overdone right now. I think we're in early stages of probably getting back to growth because. I was spending a lot of time on company earnings the last 2 weeks, and all the big guys reported: Google, Microsoft, Amazon. I mean, they're getting crushed. And while they were already down 30%, and now they're going down another 10 to 15%. So doesn't mean they bottom, but they sure are presenting great value here. Always be wary of risk. Risk management is key. It's an important component of portfolio management, investing. There's all sorts of different risks. Market risk, the obvious one. As macro, exchange risks. Google reported yesterday they had a -6% decline in earnings because of FX, because U.S. dollar index is trading at an all-time high against the basket of currencies. You have credit risk, companies getting downgraded, inflation risk, which I'll kind of touch on a little bit later. Interest rate risk, I've heard commentary that rates are only at 4%. That's not a big deal. It's still manageable. True. The only difference is when if you're an analyst analyzing a company, last year this time you were using 1% to discount the cash flow from future earnings to today's present value to come up with a valuation for a company. Well, today you're using 4%. So your valuation is going to get crushed. In fact, we've had the fastest drop in valuation in PE multiple in history in 9 months. It contracted 30% in a matter of a very short period of time, faster than 2000 when the tech crash happened. Volatility actually decreases over time. You see, if you invest in any one year period, you can have a 30% return or a -20. These are not exact numbers, but it's that wide in any given year. As you go across the sort of the 10, 20, 30 year period, you can see the range of outcomes is actually very narrow. It's not that you don't have to be a mathematician to figure this out. If you stay invested, staying the course, owning the right companies, you're going to do fine. Let's skip this one. So, I think everybody has a different risk tolerance. My risk tolerance is not the same as you or yours. Our clients, if you're older, they may not have a same risk tolerance. So there's two things. There's willingness to invest, you wanting and being able to take on risk, but there's also the ability, meaning you do have the cash flow and investments to be able to make investments. Obviously, the higher the bond component and the cash, the lower the return, but also the lower the risk. And as you go up to the far right, that's an all stock portfolio, and highest risk, highest return, and more volatility. I tend to run money somewhere around that. I'd say right now, I'm running it around 65 to 70% stocks. I'm usually, pretty much an equity investor. So, that's sort of, it's a personal choice, but our clients are in line with that as well. So I think, the value is still in stocks. I'll have a quick slide on, how are we doing on time? Yeah, you good? Yeah. Inflation. I think it's one of the most Googled words this year. I think we're all experts on what the definition of inflation is this year, the CPI and the PCI and core inflation and everything. It's sitting at a 5-decade high. We're all used to, I think your generation and my generation, I've never seen high inflation at this rate, 8-9%. UK has 11% inflation. So it's kind of not normal. Having said that, I think most people think that it's still COVID related. A lot of that supply chain issues are kind of lingering. It hasn't been resolved. I think next year, this time, we're having a very different conversation around inflation. I think it'll be much lower. In fact, when you look at the a break-even inflation, it's right around 2.3, 2.4%. Or expected inflation next year is somewhere around 2.5%. I'm not saying it may go there, but it will definitely be somewhere in the 3-4 handle. The way they've structured, inflation is pretty quirky. 40% of CPI, core inflation, is shelter, rental, and whatnot. But they also include, if you're a house owner, it's called a rent equivalent figure or whatever. So if you own a house, they ask you, how much would you rent this place? They say it's 5,000, but it may be 3,500, and they'll never bring it down. So that number is constantly, going higher. So it's a little bit kind of the way they do their calculation. I don't agree with, but doesn't matter. Inflation does have impact on all your asset classes. It has the least impact on stocks. So over to portfolio management. The first step is sort of that discovery and assessment, kind of knowing your client and what they want. I think Chris, you touched on it a little bit. But the next step is, figuring out an investment policy statement, putting together, it's a legal document that outlines your objectives, risk appetite, time horizon, any special circumstances, and it's a guideline for managing a portfolio. It's like a roadmap. You won't start, traveling somewhere you've never been with a car without a map, right? So why would you invest without a plan or a policy? The next step is really my favorite, which is implementation of that plan and putting it together. Once you have that asset allocation, and now you can get to work. How much of it do I put into this sector versus that one? Canada versus US. What companies do I pick? Look at valuation, value versus growth, etc. And then there's a constant ongoing and monitoring of these accounts and communicating with clients. You probably want to take note of some of these things. These are my favorite to-dos and do-nots. Understand what you want as an investor. Have a plan, stick to it. Do not change it every minute with every breaking news. That's really important. Have some discipline. Determine that asset allocation. Be flexible because things change, your life circumstances change, but do not change it too much. Things shouldn't change that quickly with every piece of news. Diversification is probably the most overused word in finance. I actually hate it, but it's important. It does matter, and it reduces risk. have realistic expectations. Don't invest in two companies and try to conquer the world and become a millionaire. It's a myth. It doesn't exist. There's no such a thing. 7-8% is all you can do. Most people make their money in their own businesses. That's where you make the big bucks, and then you can invest it in whether it's real estate or private investments or stock market. These are all good vehicles. Be quite wary of investment fads and that come and go. I think we just saw the largest one. I mean, that we've had, the meme stocks and some crypto and stuff. I have nothing against crypto or anything, but I think these fads have been around as long as humans have been around. It started with the tulip bubble in 1637 or something. Price of tulip went up 20-fold, and then it crashed right back down. And then we had the tech bubble, and we've had the currency stuff, and then most recently, obviously, there was too much money in the system. There was too much capital with too little sort of investments to go into it, and then it causes overvaluation. And then finally, give your plan time to work. The stuff you want to stay away from is resist market timing. To this day, I remind myself I'm still looking to buy. If I'm investing money in Bank of America the other day. I try to time in and be too cute. Don't do it. It's just, it's not worthwhile because nobody knows what the perfect timing is. One thing that I didn't include there, do not put good money after bad investments. And we've all done that. I've done it. And it's very common. You find a company that you like, and you invest $10,000, and then it gets cut in half. You're like, okay, now I should put more money into it. You invest more money and it goes down, and you invest. That's just, admit you're wrong and just, either leave it or move on. Don't shy away from cutting your losses. We do that all the time. If we're wrong, you have to be very humble in investing, because you're going to be proven wrong many times over. So, just stay away from stuff that don't work. Do more of the things that do work, actually. Investing is more of an art than anything else, and the psychological aspect of it is pretty important. This is sort of the stages we all go through: optimism, excitement, thrill, euphoria. We had euphoria basically last year when I remember I was in the elevator with a guy that I meet all the time, and every morning he was on his phone on his Yahoo Finance, and he wouldn't even say hi to me because he was so excited about his stocks going up. And I asked him, what is, and I saw the portfolio, and it was all stuff that, I was pretty confident they're not going to work out over long term, but he was doing well. So that's the euphoria stage. Then the markets start going down. You have anxiety, you go through the denial stage, fear, and then finally it hits home. I think we're somewhere around, we've had our fear, I think, the last few weeks, or September was definitely the fear stage. We're probably somewhere, we haven't panicked yet. Panic requires some sort of a break in the system. You need a bank going under, or some hedge fund somewhere blowing up. I guess what we had in England, with the UK pension, that may have been a point. Index funds, there are, I think, you touched on it, but there are broad indices like the TSX and the S&P 500, multi-market index. Sector indices, I like quite a bit. We use it from time to time. If I want to invest in a sector that, let's say I want to buy some software company, and I don't know what the best software company out there is, I'll just buy the index. It has all of it. It's a subsector of an index. And then there are different styles: value versus growth, small cap versus large cap. I think value, we've had a decade of growth outperforming value. I think we're on the verge of the value starting to outperform growth, just with where rates are. If they're sticky, we're probably going to have that for a while. Different types of ETFs, stock, bond ETFs, currency, commodities, sectors I touched on. Geographic, if you think you want to have exposure to some region because they have above average GDP growth, let's say, you think Vietnam is going to do well, or Mexico is going to do well, and what do we know about individual stocks in those countries? Just buy the ETF of that country. You can do that. These two, I want to spend a couple of minutes on it: inverse short ETFs and leverage ETFs. Try to stay away from it. They're pretty dangerous. They're mostly for trading, I would say, but These ETFs reset daily. And it really erodes your capital. That's all it does. If you look at any of those charts, if you catch them at the right time, sure, you may make lots of money, but over time, all the charts are going down, whether it's a long or a short, or they're double, triple, they're just very sort of dangerous. ETFs, I think they're great for someone who wants to begin investing. There's no minimum, they're very liquid, low cost, passively managed, and they're diversified. You can skip this one. This chart, shows you the overall market, the trend of the overall market from the 70s onward. You can see it's on a kind of a upwarding trajectory, but there's a lot of events that have happened since the 70s. We had that Black Monday was the stock market dropped over 20% in one session. It looks like a blip now, but it was very ugly at the time. The financial crisis, we had the tech bubble, obviously COVID, and that's from 2021. We've now circled back almost all the way back to pre-COVID, so all the excess is out. So the next dip, if you see this chart next year, I think we've had our dip. Again, the point is stay invested. These things longer term, it doesn't feel good while you're in one of them, but we get out of it. My last two slides are my favorite probably. This is a 60-40 classic balanced portfolio. You got institutions, everybody invests in 60% equity, 40% fixed income. It's worked out great. I think 76% of the time it goes up until this year. We had all the bond investors experience something that we've really never experienced before. This has been I think the second worst year for bonds because rates have gone from 1% to 4%. But this strategy does work. This number is as of I think it was September. I haven't updated it, but it was down 23% year to date. So if you had 60% stocks, 40% bond, and that's pretty awful because bonds are supposed to protect you. Even in the financial crisis of 2008, it held in better. So this is 94 years of data, and that's the second worst year, second to 1931, right in the middle of depression. But I think from this point on, this strategy would work great because look at when we have these big down years and what happens after that. This is a great time to actually have a 60-40 portfolio because your bond side you're actually going to make money on your bond side. And lastly, I'll leave you with I always have the debate of investing versus trading versus investing. I hear my client's son tells the father that you should trade, you should get in and out, you should sell before the recession. Well, I'm not smart enough and I can't figure it out. So I decided to look at what the numbers tell me. This is 42 years of investing. If you had $100 invested it in the S&P 500 and just left it alone, reinvested all the dividends, you would have $11,511. If you miss just the best 10 days in every year during that period, you would have half of that money. Those 10 days are random. They actually often happen during bear markets, during down markets. We've had, I think, 3 of them this past month. You're in a down market, but the spike backs are violent. And there are days the market goes up 1,500 points or something, 3, 4, 5%. If you miss those, you're going to have half. I've heard the argument too, what if you miss the worst days? Sure, your returns will be higher, but the whole point is that you can't time the market. You don't know when they're random. And if you miss the best 25 days, you're going to have not have a lot of money. With that, I'll open it up to questions.
I have a question on here. So you're talking about the whole Intel stock there as well. Now, like the whole, I guess, reason for the funding there is a variety of different reasons there. For example, even like the new advancements with microprocessor technology with AMD, or heck, even just let's say Apple, and then like I guess steering themselves forward, making it all silicon bit. So do you have any like I guess like resources here or other like tips you can say where like students can actually look into like and actually see where these trends are going? So like let's just say Fox News. I'm not really sure if that's a very credible source there, or are there any other ways that we can really see?
For research, you mean?
Yeah,
Yeah, I think both. I mean, that kind of research is paid research. Like we have access to RBCs and all these other banks and stuff. That's the analyst research, but like you can do your own work. I think right now with I like Seeking Alpha quite a bit. It's independent research, but I've seen a lot. I use them. There's a lot of good material there. And just, start following companies, get to know them first. If you're investing, if you like investing in individual companies, buy what you own, what you know. If you use I don't know if you like Nike or something, look into that stock. That's a stock that's come off, by the way, on almost 50%. And since it IPO'd, it's never been down that much. We just started buying it. And, those are kind of examples that you don't get that kind of opportunity. If you were the owner of Nike and at the beginning of the year, your company was worth, let's say 200 billion, and 6 months later, it's worth 100 billion. And I came to you, I say, oh, I'll buy your company for 100 billion. You would, kick me out of your office. Why would you? Well, what's happened that it's gone down 50%? So it's market sentiment and valuation, of course, but these things will come back. I would say, yeah, Yahoo Finance, Google Finance are good resources. You don't get actual research, but there are research out, and all the companies' balance sheets, and it's all out there. You can read it. But if you're ever investing, if you're actually into the numbers and you're digging deeper, start from the management discussion at the end of the report. Read that. There's always the best material is there. But that was a classic competition. I mean, with the chips, they were always behind. AMD was always a step ahead, and they had the smallest chip, and then Intel would invest and come up with that chip 6 months later, and then they would already be onto the next technology, right? So, yeah.
I mean, just the reason I'm asking is like, well, if you look at TikTok, there's like 1,000 apparently finance gurus out there doing invest in this stock, invest.
Right.
I'm not really sure if that's really credible there, but you said like Google Finance, yeah.
Yeah, and I think that that's a great point. I think TikTok is not a good investment resource, right? And I think TikTok and Instagram. I mean, if you're investing, like we invest serious money, right? If I were to go on, if I'm in front of a board of a pension plan, and they say, they'll question sometimes, what's your reasoning behind investing, $10 million in, Nike? And if I tell them that, I mean, I saw a video on TikTok, and think about that I would lose that account quickly. But there's a lot of public material out there. I think we've all become sort of, how do I word this correctly? Anyways, I think you have to do the work. To investment, there's a lot of research involved, and you have to do hard work actually. Just be patient, and good companies. If you buy a good company, it will always work. If they have a competitive edge, the leading companies, I think we all know who they are. It's not rocket science. You can probably all name 10 companies. Whether it's Google, Microsoft, Nike, Royal Bank, Bank of America. These companies, they're all good investments, and they're going to do well because they're run by smarter people than us. So, for most part, not always. Yeah.
We're open to one more question. But there's two. We'll just have two. What's your favorite stock right now?
The last time I answered that, it was a banker that we worked with, and I never heard the end of it because it was just the stock went down, and yeah. It's not just one stock. If I buy something, I want to. If I buy, my recent purchase is Bank of America. Let me put it that way. I think it's good value. It's come down. I think banks are making, for the first time in 15 years, they're making money on net interest margin. So because rates are going up, they actually make money. I think banks are making money on all of us because they give you, 3% interest, but they charge you on your mortgage 6%. I mean, what a better business is there, right? So they're making good money on that. There's going to be slowdown, so there's going to be credit losses and whatnot, but the net interest margin will offset that. It's a cheap sector. I think they're trading at 9-10 multiples. So I think, yeah, Bank of America is a good example. I like the utilities in Canada. I think they've come down quite a bit. They pay good dividends. Do you have a question?
So if timing the market isn't the way to go, how come those algorithmic or quantitative trading firms are still actively printing money?
Well, those same algo funds or quant funds, a lot of them are in the round. So they go bust basically because they'll catch a trade if most of the crises happen in those exact kind of sectors of the market. Because they'll get something wrong and then they'll blow up, right? Because there's only so much mathematics that can do the work. At the end of the day, there's emotions that are involved. The best example is 2 Thursdays ago when the CPI print came out, the market got crushed in the morning. All those funds were the reason for selling. Okay, so what happened is the market tanked at the open. And so all those quant programs, they were told to sell because the market broke a very key level. By the end of that day, the market rallied 6%. So, you tell me what the strategy is then. So, sometimes they work, other times I think a combination is good. Having some quantitative analysis, having some fundamental, and having some technical analysis. I think a combination of them is good. Just one standalone strategy doesn't work.
Awesome. I think that's it for the questions for now, but we will have a 5-minute break. So if you do have any more questions, you can pass it off to Ashkan. But yeah, I just want to say thank you to Ashkan. Let's give him a hand. Yeah, I'm personally thinking about my own euphoria moments. I really resonated with that. But yeah, if you do have any questions, is it okay if I share your LinkedIn with the rest of the group? Yeah, I'll share that LinkedIn with you all if you want to check him out. But we'll have a 5-minute break now, so you guys can use the washroom again, mix and mingle with everyone else. But be back at around, let's say 7:30. Thank you guys. Well, welcome back, everyone. Thank you for Ashkan and Christopher for speaking so far. Now we'll be moving on to our last speaker of the night, Annika. She is part of Blossom Social, and let's give her a warm welcome to the stage. So a little introduction of Annika. You can come start. She's the co-founder of Blossom as well as the COO of Blossom Social. She has a wide variety of experiences in the Canadian financial institution space. She used to work at Canada Western Bank. So I'll give the floor to her. Thank you.
Hey everyone, I'm super excited to be here chatting with you guys today. Yeah, Ashkan and Chris absolutely killed their presentations. I'm worried my presentation might be a little bit too simple, but hopefully it's effective and gets to the point. But just to start off with an introduction of myself, my name is Nicola, as Lance mentioned, and I'm the co-founder and COO of Blossom Social. We're a fintech startup building Canada's first social brokerage. So you can think of it as like mobile first stock trading with a social community layer on top. So yeah, just to talk about myself a little bit and introduce myself. I'm also a SFU BD alum. I concentrated in ops and MIS. And then during my undergrad, I was also elected BAS president. I was also the creator of the BAS Celebration Gala, which I believe is an annual event now. And yeah, as Lance mentioned, I have worked at a bunch of different places throughout my undergrad. And then also when I graduated, I was at TD, I've been at Canada Western Bank. And then I was also at Arc'teryx as an operations specialist. And I just left my full-time job at Arc'teryx to run our startup full-time in January of 2022. And again, to flex Blossom a little bit, we've been doing this whole thing for about 1.5 years. We've raised $1.2 million in venture funding to date to build out Blossom. We were selected as one of 12 startups in North America for the Google Startups Accelerator and won a few pitch competitions and stuff. So yeah, we've had some awesome momentum in the past 6 months, just to throw my credentials out there before we get started. But yeah, I'm here today to talk to you guys about some different investing tools. So both Ashkan and Chris kind of went over with you guys the different types of things you can invest in. So you can invest in stocks, ETFs, mutual funds, bonds, all that good stuff. And they also chatted with you guys about what buckets you can invest those things into. So TFSA, RSP, cash accounts, different accounts. But what I want to chat with you today is how do you actually choose what to put into each bucket? How do you know what stock to choose, what mutual fund, what ETF? How do you pick those things to put into your buckets? So the 3 most common ways, I would say this is not exhaustive, but the 3 most common ways, number 1 is through a financial advisor. So this is someone, you go to your bank, you speak with a professional, they help you decide what to invest in. And number 2 is through a robo-advisor. So this is kind of like, you can think of like Wealthsimple or TD Easy Invest. So it's obviously similar to a financial advisor, but it's done automatically through AI. And then the last way is doing it yourself. And so I wanted to touch on a little bit of these 3 ways and what their pros and cons are and how you can decide what to use. Just as an FYI, I personally use all three ways. You don't have to pick one and only do that one way. I don't use the robo-advisor actually anymore. I tried it out, didn't love it, but I do obviously have friends who use all three ways, so it's up to you. But yeah, financial advisors. So some of the pros of using a financial advisor. You're obviously getting quote unquote professional advice and guidance. So they do this for work, they know what they're talking about, supposedly. But sometimes they can prevent you from making costly mistakes. Obviously, if you're doing it yourself, there's always a risk that you choose the wrong thing. And they also save you time, right? They are managing your fund for you. And yeah, some of the cons of a financial advisor, however, is they can often be really expensive. So obviously they're not managing your money for free. There's a lot of fees baked into the costs of investing through a financial advisor. Sometimes there can be conflicts of interest. So I don't know if this is common knowledge, but I obviously worked at some financial institutions for a long time. And sometimes they actually have an incentive to get you to invest in certain products. So there can sometimes be conflicts of interest there. So it's just something to be wary about. And you also become dependent on them for knowledge, right? You're not investing, doing these things for yourself. You're not doing your own research. You're kind of dependent on them to make those decisions for you. Robo-advisors, as I mentioned, very similar to financial advisors, but obviously through AI, less expensive. You don't actually have a real person investing for you. It's really easy to start. You can often invest with as little as like $1 through a lot of robo-advisors. And they're also obviously really easy managed. You kind of set it and leave it. Cons, they're more costly than DIY. You're still having to pay for those management fees. And they can often take a narrow view of your investment. So obviously with a financial advisor, you're having like a real person to talk to who can, take in what your situation is. And then obviously if you're doing it yourself, your own financial situation. So it can sometimes be a little bit of a narrow view. And yeah, limited personalization. Doing it yourself. So pros of doing it yourself. Super low cost. You don't have to pay a management fee for someone else to do it for you. You have access to more choices. So if you go through a financial advisor or robo-advisor, they're often limited to what their institution offers. So sometimes you don't get access to all of the choices that you would if you did it yourself. Building financial literacy. So obviously the best way to learn is by doing things yourself. Best way to learn is by doing. So you're building your own financial literacy there. And no hard selling. You're not getting sold on a product that may not suit your needs. And the only con to DIY investing is you might make the wrong choice. With that being said, though, I would no matter what, if you're investing, there's no risk-free investing. So even if you go with a financial advisor who's quote unquote a professional, there's always that risk that you're going to lose money, you're going to lose your investment. So obviously with doing it yourself, there's a risk that you might make a worse mistake than a financial advisor might. So yeah, what I want to chat with you guys today is mostly on the DIY investing part, right? I think we're all here to kind of learn more about investing and how to make those choices. Obviously you all have an interest in that. So I wanted to talk a little bit more about DIY investing and some of the really interesting statistics that we've seen in the past years. So DIY investing has actually become more popular than ever. In 2020, the number of DIY brokerages rose by 159% just in Canada. So in 2019, I think it was about 849,000 DIY accounts were open compared to 2020, where there was over 2.3 million open. So you can definitely see this is like a crazy trend with the younger generation. And then in 2021, there was a consumer survey done that over half of investors believe that they can actually do a better job themselves than a financial advisor, obviously net of those advisory fees. I personally definitely fall into this bucket of, I think I could do a better job than an advisor. I used an advisor up until I graduated university because I didn't know better. My mom uses, an advisor at RBC. So I just went to her and she would help me invest in mutual funds. But once I graduated and actually started building my own financial literacy and actually took a look at what the mutual funds that she was investing in, I was like, oh, this isn't that, she's not investing in anything crazy. A lot of it is like S&P 500 or just, a generic ETF. And I was like, oh, I can do this myself and save myself those fees that I'm paying, getting her to manage my fund. So a lot of investors feel that they could do a better job. And especially nowadays, I think now we have literally all the information in the entire universe at our fingertips at all times. So a lot of people, I think, are leaning towards that way where they can do their own research. And another really interesting trend with the younger generation is that investing is becoming more social. Just in the last presentation, we had Armand who asked about, and commented on like TikTok, right? So like social is becoming such an important part of investing, whether it's great or not, right? It is a part of it. 2/3 of investors who I would say like are millennials / older Gen Z discuss with their friends and are actually 3 times more likely to go online to look for advice than actually go to a financial advisor, which is really interesting. And so I wanted to talk a little bit more about some websites or some tools that you can use to do your own research if you're interested in. This is not an exhaustive list at all. These are, I would just say, like some of my personal favorites. So Yahoo Finance, I think, is probably the best one for like monitoring your stocks. It shows your stocks in it like shows how the stock is performing in real time. So this is a great one to like download on your phone and have just check the app if you want to see the performance of your portfolio. And then the remaining 4, I think, are really great for like stock research, market analysis. Some of them you do have to pay for, but if you're like really into it, I definitely recommend Seeking Alpha, which is one that Ashkan mentioned. And then Bloomberg at the bottom is Soraka's favorite. I don't really personally use it, but Soraka said he loves it, and I don't know where he is, but anyway, yeah. He was like, make sure you include Bloomberg. So I was like, okay. But anyways, not an exhaustive list. There's so many of these tools out there, guys. So yeah. Another resource or tool that I wanted to talk about is online communities. This is not, I don't recommend any of these communities. I just Googled like online investor communities, and these are some that came up. But if we're talking about social and how social is becoming such an important part of investing nowadays, there's so many online communities that you can join, and you can chat with other like-minded investors. You can see what's going on, what other people are investing in. Bay Street Bets, I think, is probably the most popular one. It's on Reddit. It's like the Canadian equivalent of Wall Street Bets. So yeah, we can see the prevalence of online communities. There's so many out there everywhere. But the problem with these online communities, which is, again, something that we've already touched on, but they weren't made for investors, right? They're just generic social media platforms. So they're not promoting intelligent voices all the time. They're full of misinformation, sometimes even scams. I literally just looked up on YouTube, like next stock to 10x, and like found a shit ton of videos. Like this one here, it's like next stock to 10x, like putting 250K in fast. It's like, okay, it's sus. But so like, yeah, so there's a lot of these kind of things out there, and you can see like the top one, like 194,000 people watched that. Like that's a little concerning that a lot of people are very gullible, right? So it's like you see a lot of these things. There's a lot of great information, don't get me wrong, online, and that people are sharing, but there's also a lot of misinformation. So with that being said, we need to make sure we're being cautious, we're using common sense, right? And we're not falling for these scams, I would say. Can't remember what I have. Oh yeah, so going into like just general advice on how to avoid bad investments. Ashkan touched on a lot of these already, but establishing an investing thesis and sticking to it. Again, I think Ashkan did a really great job of talking about this already, but basically an investing thesis, your investing plan, your guide or whatever, have like a thesis that you invest by and stick to it. So if you're going to be like, I'm only going to invest in, I don't know, dividend stocks, or I'm going to invest in a company that I think is undervalued and hold that stock for at least 1 year or until it hits a certain price, and I'm going to sell it for sure. So just having like a guide or a set of rules for yourself on how you want to invest will really prevent you from making those fatal mistakes, from making you make decisions that are impulsive or emotional. So yeah, I definitely really recommend doing this. Picking companies that you actually believe in. Again, we touched on this. Ashkan gave a great example about Nike. I actually have a friend when I was in second year, she wanted to get into investing and her boyfriend was like a finance bro. So she was like, oh, how do I start investing? And he was like, well, why don't you pick a company you actually believe in and you actually like buy their things. You're actually a consumer. And so she actually picked Aritzia. And so she invested in Aritzia. If you look at Aritzia from 5 years ago today, the stock is up 400%. So if she held that investment for 5 years, like she would be balling right now, basically. So picking companies that you actually believe in, you actually are a consumer of, is a great advice for your investing thesis. Avoid meme stocks, just don't do it. Which we touched on a little bit, unless you're a degenerate and have like a shit ton of money to throw away, just like don't do it. Be patient, don't let your emotions rule. Again, with that investing thesis, a lot of people panic sell. So as soon as they see their stocks going into the red, they're like, oh my God, I gotta like sell right away. I'm gonna lose so much money. So as long as you have that thesis and you're sticking to it, that's not gonna happen. And then picking the right tools for your insights. We touched on a little bit of the tools that you can use, the stock research websites, you can use online communities. But no matter what you're reading, always ask yourself, what is this writer or content creator getting out of sharing this information with me? And this is applicable to like any information that you're getting, including financial advisors. I touched on a little bit how some financial advisors actually have an incentive to get you to invest in something. They actually make commission. I don't think they label it as commission, but it's pretty much commission. So it's just good to know that in the back of your mind, and whatever information that you're consuming or you're reading, I would recommend checking multiple sources and actually doing like your own due diligence outside of that one recommendation you're getting. And then obviously I'm from Blossom, so I'm here to plug my own stuff, but you can use Blossom to check out people's real portfolios and trades. So basically how we came about making Blossom is we experienced this problem firsthand, myself and my two other co-founders. And we noticed the trend of social becoming more and more popular in investing, especially with the younger generation. And we were like, okay, let's do something about this. How can we innovate on the stock market, and how can we innovate on the space? So we basically are building Blossom, which is going to be Canada's first social brokerage. On Blossom, your profile is your portfolio. So people actually link their brokerage and share their real portfolios with people. It's just your percentage allocations, not dollar amounts, but you can actually see what people are investing in. And you can actually also see their trades in real time. So this is great for like a lot of FOMO is a huge part of investing. So if one of your buddies makes a trade, you can actually see that they just invested in it right now, and you can, chat with them about it in real time. And so you'll never really miss out there. But this is a great way to actually put, a face to an insight that you're getting. So if someone's like recommending a stock, you can go on Blossom and actually see their portfolio. Are they putting their money where their mouth is? Yes or no? If they're not, then it's like, okay, why are you promoting a stock if you're not even holding it yourself, right? That's a little sus as well. So yeah, that's Blossom. As you can see on the right there, there's like a news feed, or just like a generic feed where you can see people's trades. We're going to become a full service brokerage soon. We don't have this function yet. We're just going through IROC regulatory processes right now, but in about a year, you'll be able to buy and sell stocks directly. We're going to be a discount brokerage. So Chris touched on that a little bit. So you won't have to pay fees for your trades, similar to Wealthsimple or Questrade. I think if you trade through like your bank, you're paying like $5 or $10 per trade. So that's a little bit about Blossom. If you want to download it, feel free to download it, and you can use code FINSA if you want to support FINSA. But yeah, in summary, guys, there's 3 different ways that you can use to invest in the different buckets. So that's financial advisors, robo-advisors, or just doing it yourself. And if you're doing it yourself, make sure you're doing your due diligence and using resources and multiple resources. Yeah, that's it from me.
Does anyone have any questions for Nicola?
Hi.
Hi, I have a general question on, I don't know how we pronouncing it correctly, but fiduciaries. What are your thoughts on like fiduciary advisors that are not mixed? They're just pure fiduciaries.
Like what my opinion is on?
Yeah, what your opinion on it, so the fact that they can't give you like unbiased.
Yeah, I mean, I think with financial advisors, like I think most of them should be having your best interest in mind, obviously, but there are times where, say, if there's like two different options, they might be pushing you in one way and it still fits into your investing thesis and what you need or what you're trying to accomplish with your portfolio. But maybe they get like a little bit of incentive pushing you this way versus this way. So I think just in general, like what I'm trying to push here is like, just do your own research. Don't trust opinions blindly that you're getting, even if they're coming from a professional. I would, just recommend like checking multiple sources, doing your own due diligence, and hopefully that helps. Yeah.
What's thoughts on your person investing in right now?
Yeah, great. Oh, I wish I should have put a picture of my portfolio. Yeah, so if you download Blossom, you can check out my portfolio. But I'm holding 43% of my stocks in VFE, which is just like the S&P 500. Disclaimer is I still have a big chunk, I would say half of my investments with my financial advisor at RBC in mutual funds. But for my DIY account, I'm mostly in VFE, which is like pretty safe. It's just S&P 500. I hold TD, I hold Visa. I have a few like small cap stocks. I met like the founder of this company called, what are they called? Hope and Sesame. Their ticker is like MYLK, which stands for milk. They're a really cool company. They're based in Calgary. They're making like sesame milk, which is supposed to be like the new oat milk, apparently. So that one's actually doing pretty well. I'm holding Aritzia, Amazon, another small cap that I'm down 68% on, which I don't recommend. That one was one of the ones I like hopped on the bandwagon and it was not a good idea. AQN, which is a really good one, Microsoft. So my portfolio is not that interesting, to be honest. But there's a guy on Blossom whose handle is literally buy VEQT. So he's just like a hype man for this ETF. And it's really funny. But anyway, you can check out a bunch of people's portfolios that are linked on Blossom. And so I love just like stalking people and see what they're holding.
Awesome. A lot of times when people are actually doing these, I have a question. They're great as people ask questions. I know that lots of us done a really good job at the creating an inclusive environment, but can you highlight what steps you take?
Yeah, that's a really great question. That's actually something we're definitely still struggling with because a lot of these communities are really like a little scary, right? Because you go online and people are like using jargon that you've never heard of and all that kind of stuff. But I think for us, it's like we've worked really, really hard to build a community that's very inclusive. And we're about to put in like a set of guidelines for the community and all that kind of stuff. But I think I would recommend, like, if you're a little bit nervous and you're more of a beginner, I would recommend just mostly like posting comments like on other people's posts, because I find sometimes if you post something that's like kind of quote unquote stupid or a little bit more beginner, like people are less friendly. I'm thinking mostly of Reddit. So I would just recommend, like, if you're going on Bay Street Bets or like Canadian Investor, all those things, like, I think the best way to engage with those people is usually through comments of other people's posts. But that's a really tough question. I think for us, like, the best way to build a community is just like really being clear about like your values in the community. So for us, like, knowledge sharing and transparency is like at the front and center of our community. So if people aren't sharing their sharing their portfolios, we're not going to highlight their opinion or voice as much as someone who's like actually willing to share and help out other people. I don't know if that answers something, but yeah.
Well, let's give a hand to Nicola for.
Yeah, so appreciate it. As you guys know, if you guys do sign up today, we will be giving out a prize. We actually have, I think, 3 or 4 prizes. A few of them are $25 gift cards to Visa, Visa gift cards, as well as Starwood gift cards. So if you guys do sign up, we will be posting the winners on our Instagram later this week. So if you guys do, it'd be a great help to Blossom, but also FINSA as well. With that being said, I'm going to wrap up this event that we have here today. But before we move on, I'd like to thank again our sponsors, We'll be giving away a Red Bull if you guys want some for your midterms this season. We have a bunch of Red Bull sponsored by Red Bull. We also have Blossom, CFA, BD, RBC, and Bradner. We want to appreciate them because they really made this event possible. But also, I'd like to talk about a few events that are coming up this November as well as December. Our very first one is going to be a really special one to myself. It's going to be the very first finance-based case competition here in BD. Be the very first one and the only one ever. So this one's going to be an M&A case competition, so mergers and acquisitions. It'll be a mid-level case competition, so it'll be too difficult. Everyone's welcome to come. And yeah, the signups will be towards the end of October, towards the beginning of November. So if you guys check it out on our Instagram, LinkedIn, various social platforms, it'll be there as well. The second one's our impact investing. We know that the environment is very important. Also social SPOs, social purpose organizations are very important for investing as well. So we will have speakers coming out who are in that impact investing space to kind of speak about that. Finally, next year, starting in January, we will actually have a mentorship program called the IPO mentorship program, where we will actually have industry professionals come in, have one-on-one sessions with the various students who sign on our mentorship program, as well as have various networking sessions and little workshops that be able to help teach you how you can get into the financial industry and be able to learn more about that. So those are 3 things that are upcoming. So definitely check out our various social media pages. It'll be a great way for you guys to learn more about that. Last but not least, I just want to say a big thank you for the various FINSA members here tonight, Joaquin and Jeffrey, making everything possible for tonight, as well as the coordinators and various executive members. Want to give them a hand because they put a lot of work in to make this possible. Also, one last hand to our various speakers, Christopher, Nika, Ashton. Thank you for coming out tonight. But yeah, that wraps up everything here tonight. If you guys can scan this, fill out a form. This just gives us a little bit insight of how our event went today and be able to give us a little bit insights of how we can improve upon next time. But that wraps everything up. Appreciate each and every single one of you coming out tonight. Thank you.